When it comes to growing your wealth and ensuring a financially secure future, one rule stands out: compound interest. It's often called the magic of compounding because it can turn small savings into big money over years. Whether you're new to managing money or experienced in investing, knowing about compound interest is crucial for reaching your financial goals in the long run. In this video, we'll explain how compound interest functions, why it's incredibly effective, and how you can use it to build your wealth steadily over time. So, what exactly is compound interest? Well, compound interest is a concept where your money grows not just on the initial amount you invest, but also on the interest that accumulates over time. This means you earn interest not only on your original investment, called the principal, but also on the interest that has been added to your account from previous periods. In simpler terms, it's like earning interest on top of interest. The real power of compound interest lies in its ability to make your money grow exponentially over time. This happens because as your investment earns interest, that interest is added to your principal. Then, in the next period, you earn interest on this larger amount, including the interest that was added before. This compounding effect continues to snowball, accelerating the growth of your money. Time is a critical factor in maximizing the benefits of compound interest. The longer your money remains invested, the more time it has to compound. Even if you start with small amounts, regular and consistent investments can lead to significant results over time. This is why financial advisors often stress the importance of starting early when it comes to investing. The longer your investments have to grow, the greater the impact of compounding. For example, if you invest a certain amount of money and leave it to grow for several decades, the power of compound interest can turn a modest initial investment into a substantial sum over time. This is particularly advantageous for retirement savings, where starting early and allowing your investments to compound can make a remarkable difference in the size of your nest egg. To begin, it's important to save and invest as soon as possible. The earlier you start, the greater the benefit of compounding. For instance, investing in retirement accounts or index funds regularly ensures that your investments have more time to grow. This consistency in investing, coupled with the power of compounding, can significantly enhance your financial outcomes over the long term. Let's consider an example to better understand this concept. If you invest $250 per month in a retirement account, earning an average annual return of 7% after 30 years, your total contributions will amount to $90,000. However, due to compounding, your account balance could potentially grow to over $300K plus during that time if you achieve an average 7% return. This illustrates how the growth of your investments accelerates as the earnings on your investments themselves start generating returns. Consistency in investing is also crucial. Making regular contributions, such as monthly deposits into a retirement account, boosts the power of compounding. Even small, regular investments can grow substantially over decades. Reinvesting dividends and interest, rather than taking them as cash, further accelerates compound growth. This means your earnings are continually reinvested to generate more earnings. Investing in low-cost index funds and exchange-traded funds, ETFs, is often recommended for long-term growth. These funds typically have lower fees and allow you to diversify across many assets, which can reduce risk while benefiting from overall market growth. Understanding your risk tolerance and maintaining a diversified portfolio are essential for managing risk effectively. Risk tolerance refers to how comfortable you are with the ups and downs of the market. A diversified portfolio spreads investments across different types of assets, industries, and geographic regions, helping to minimize the impact of any single investment's performance on your overall portfolio. To succeed with compound interest, patience is key. Compound interest works best over time, gradually increasing your savings as both your initial investment and the interest it earns are reinvested. This compounding effect snowballs, especially in the later years of your investment. It's crucial to maintain a long-term perspective and not be swayed by short-term market fluctuations that may cause temporary dips. For example, investing $5,000 annually for 30 years at a 7% average return can grow to over $1 million due to compounding. One effective strategy is set it and forget it. This means automating regular contributions from your bank account to your investments each month. By doing this, you save mental energy and ensure steady growth over time. This method aligns with the principle of compound interest, where consistent contributions lead to substantial growth over the years. Understanding the rule of 72 further enhances your grasp of compound interest. It's a straightforward formula used to estimate how long it takes for an investment to double based on its annual interest rate. Simply divide 72 by the interest rate to find the approximate number of years required for your investment to double. For instance, with an 8% interest rate, your investment would double in around 9 years. 72 divided by 8 is equal to 9. This rule helps investors gauge the potential growth of their investments and make informed decisions about their financial future. To understand compound interest well, you reinvest the interest you earn. This means when you invest in something that pays dividends, you're accelerating how your money grows. It's like your money is having babies, and those babies are also having babies, growing exponentially over time. It's also wise to diversify where you invest for compound interest. Don't rely on just one method. Consider high-yield savings accounts, retirement accounts such as 401(k) plans and IRAs, and a mix of stocks like index funds. By spreading your investments across different options, you can benefit from varying rates of return and reduce risks. Young people often forget to save money when they start working. They might think other things are more important right now, and they have plenty of time to save later. But the sooner you begin saving, the more you can benefit from compound interest, even if you're only saving small amounts. And it's important for planning your retirement. When you start saving for retirement early, your later years are likely to be more comfortable. For example, someone who begins investing in their 20s can potentially accumulate more wealth by retirement compared to someone who starts in their 40s, due to having more years for their investments to grow. With the power of compounding on your side, you can harness the potential of your investments to build a substantial retirement nest egg. Investing wisely can make your financial dreams real. Compound interest is key. It grows your money faster over time. Start early for better results. Regular contributions plus compounding help achieve long-term goals and secure your future. Remember, investing is a marathon, not a sprint. Start now, be patient, and let compound interest build your wealth. How are you planning to start your investment journey today? Don't forget to like, share, and subscribe for more financial tips.